Welcome to this explainer on market capitalization. Today, we are going to literally peel back the onion on how to truly value publicly traded companies. We're going to break down the mechanics of market cap, explore market weight classes, and uncover exactly why judging a book by its stock price is a massive mistake. Let's get right into it. Okay, let's dive into this by shattering a very common beginner myth. It's incredibly tempting to see a stock trading at $500 a share and just assume right off the bat that the company is 10 times more valuable than one trading at $50. I mean, it feels intuitive, right? A bigger price tag must equal a bigger company. But in the financial world, that is a complete illusion. Here is exactly why that illusion falls apart. Let's say stock A costs a hefty $500 per share. But if there are only 1 million shares in existence, the entire company is worth $500 million. Now, look at stock B. It's only $50 a share, but there are 100 million shares out there in the wild. Do the math, and wow, stock B is actually a $5 billion company. It's actually 10 times more valuable than stock A overall, even though its individual price tag looks like a bargain by comparison. And that brings us to the formal definition of what we were just calculating: market capitalization, or just market cap for short. Put simply, market cap is the total value of a publicly traded company's outstanding common shares. You can basically think of it as the public market's collective, real-time vote on a company's total equity value. It's the price tag for the whole shebang, not just one tiny, isolated slice of it. To put that kind of scale into perspective, just look at this number: $2.5 trillion. That's a staggering amount of money, and it serves as a perfect real-world anchor for what a mega-cap company looks like today. Specifically, that's roughly the valuation Apple has hovered around. So when you hear the financial news talking about Apple or Microsoft being worth trillions, they aren't talking about their revenue or their profit or a single share price. They are talking about their massive market capitalization. Calculating this yourself is actually super straightforward. It's a quick 3-step process. Step 1, you just grab the company's latest closing share price. Step 2, you find the total diluted shares outstanding. And step 3, you just multiply them together. It really is basic math, right? But, and this is a big but, getting step 2 right is where amateur investors totally get tripped up. So the crucial point is that you absolutely must use the fully diluted share count. See, companies often have potential shares hiding in the wings. We're talking about things like employee stock options, warrants, or convertible debt. Factoring all of those in ensures you get the true, fully baked share count. If you don't use this method, you're basically guaranteed to underestimate the company's actual size. Now, once we calculate that accurate market cap, we can use it to actually organize the stock market. Just like in wrestling or MMA, the financial markets use market cap to sort companies into different weight classes. And this is vital. A company's weight class tells us a ton about its baseline risk, its overall stability, and where it currently sits in its business life cycle. Based on official FINRA guidance, the market is broken down into these specific tiers. At the undisputed heavyweight level, you've got your mega caps sitting at over $200 billion, stepping down through large and mid caps. On the lighter end of the spectrum, small caps range from $250 million to $2 billion, and anything below that threshold is considered a microcap. These aren't just arbitrary numbers. These distinct tiers represent a company's stage in its overall growth journey. Now, what's really interesting about this slide is the stark contrast in what these categories actually mean for you as an investor. Large caps, those are your dominant industry leaders. They are mature, they're incredibly stable, and they often pay reliable dividends. They are built for capital preservation. On the flip side, small caps are young, hungry, emerging companies. They offer the potential for absolutely massive, rapid growth. But make no mistake, that potential comes hand in hand with significantly higher market volatility and risk. Actually, think of it this way. Larger ships are steady in rough seas but move slower. Smaller ones are agile and fast, but also more vulnerable to waves. I love that analogy. If the broader economy hits a nasty recession, the rough seas, a mega-cap cruise ship will probably weather the storm just fine. A small-cap speedboat, though, it might completely capsize. But on a sunny day with clear waters, that little speedboat is going to outpace the massive ship effortlessly. And this is exactly why smart investors balance these different market cap sizes to stabilize their own portfolios. By mixing large cap stability with mid and small cap growth potential, you effectively spread your exposure. If your large cap stocks hit a slump and underperform for a while your smaller, agile companies might just pick up the slack, which helps to smooth out the overall roller coaster ride of your investments. All right, so market cap is incredibly useful, right? But here's where we really need to put our analytical hats on. As great as market cap is for sizing up a company and building out a balanced portfolio, it is absolutely not the ultimate measure of a company's worth. In fact, relying solely on market cap can be highly misleading. We need to peel back this final layer and look at the fundamental blind spots of this metric. The single biggest blind spot is that market cap only measures equity value. That's just the value of the company to its common shareholders. It completely ignores how the company is actually financed. To find the true intrinsic worth of a business's operations to all of its stakeholders, we have to look at enterprise value. Enterprise value accounts for all capital sources, meaning it looks at the equity, yes, but it also crucially factors in the company's debt and its cash reserves. Let's move to and see how this builds exactly. Bridging the gap from a simple market cap to a comprehensive enterprise value is actually pretty logical. Step 1, you start with the market cap we already learned how to calculate. Then, step 2, you add in the company's gross debt. Why? Because if you bought the entire company tomorrow, you'd have to assume all of its debts. Finally, step 3, you subtract their cash and cash equivalents, because that cash could theoretically be used immediately to pay off some of that debt. The end result is the true enterprise value. To see why looking at this is so absolutely critical, consider Company A and Company B. Both have a market cap of $10 billion. If you only checked the market cap, you'd probably think, okay, identical investments. But wait, Company A has $5 billion in cash and zero debt. Its enterprise value is actually only $5 billion. Meanwhile, Company B has $5 billion in debt and is actively burning cash. Its enterprise value is $15 billion. Company B is heavily leveraged and vastly riskier, yet a simple market cap search completely ignores their balance sheets. So, just to summarize these core limitations we've been talking about, market cap completely ignores cash reserves and debt. It entirely overlooks the capital structure of the business. It fails to reflect future growth potential, which honestly often penalizes high-growth startups that are aggressively reinvesting their cash. And perhaps most dangerously of all, because it's tied directly to the daily stock price, it is highly susceptible to market sentiment, irrational swings, and pure, unadulterated hype. And history proves exactly how dangerous this can be. Just look at this quote. During the dot-com bubble, companies with no profits achieved massive market caps based on speculation rather than business strength. It happens time and time again. Market psychology and the fear of missing out, good old FOMO, artificially inflated market caps to astronomical levels. When investors relied solely on market cap as a valuation metric without actually looking under the hood, the eventual crash wiped them out. So the main takeaway from our explainer today really boils down to this. Market cap is a fantastic starting point. It tells you the size of the company, it helps you place it in a proper weight class, and it absolutely sets your expectations for risk and volatility. But to find intrinsic worth, it must be combined with deeper fundamental analysis. You have to look at enterprise value, price-to-earnings ratios, and cash flow analysis to actually get the full picture. The very next time you check a stock ticker, don't just let yourself get mesmerized by the share price or some flashy trillion-dollar market cap. Dig into the balance sheet, consider the debt, and ask yourself this final, crucial question. Are you paying for market hype, or are you paying for true enterprise value? Thank you so much for joining me for this explainer, and hey, happy investing.